US stocks rise as traders find comfort in hopes the Fed will cut rates. All eyes are on how hawkish the RBA will be today. Indonesia's GDP is boosted by election spending, and holiday travel data shows China's consumers may be coming out of their shells. That's coming up in our 5 Things in 5 Minutes. And then in part 2 of our bonus deep dive interview, ANZ's Chief Economist for Greater China, Raymond Yeung, analyses the outlook for the US dollar and US Treasuries if Donald Trump wins the US presidential election in November.
We have seen that China had already started cutting down the US dollar holding in the past few years. But still, the market may react to this type of news negatively, and that will definitely affect the market pricing of US Treasury.
But first, in 5 and 5 with ANZ, US stocks are up on renewed hopes the Federal Reserve can cut interest rates this year. That beds in the market reaction after Friday's softer-than-expected jobs data in the United States. The S&P 500 up 0.75% at 4 a.m. Sydney-Melbourne time. The US Treasury yields and US dollar were largely flat. The yen weakened slightly, and the dollar was trading up 0.6% this morning versus the yen at 153.87. The Aussie dollar trading up 0.3% at 66.28 US cents, and the Kiwi up 0.1% at 60.13 US cents. The main drivers for both currencies will be the Reserve Bank of Australia's rates decision later today. ANZ Head of Australian Economics, Adam Boyton, expects the RBA to stay on hold at 4.35%. But he's watching how hawkish the RBA will be, with markets pulling back on expectations for any cuts this year following strong CPI data.
I think the rhetoric will change in the statement in 2 ways today. The first is the bank will acknowledge that inflation was a little higher than what they were forecasting back in February. And secondly, in the all-important final paragraph of that post-meeting statement, I suspect they may include a sentence to the effect that there is some risk that the return of inflation to the target range could be delayed. And that sentence will give that final paragraph a much more hawkish tinge than we had in the last post-meeting statement.
Number 2, the ANZ Indeed measure of Australian job ads rose 2.8% in April from March, having fallen 1% in March. ANZ economist Maddie Dunk says a downward trend in job ads that was evident through most of 2023 troughed out in November, and the index has risen 3.9% since then, when it was expected to keep falling. And it's been steady for 3 months.
The resilience of ANZ Indeed job ads just highlights the broader resilience that we've been seeing in the Australian labour market. If you look at our job ads measure, you look at the ABS's job vacancies index, or even the proportion of businesses that are saying labour is a constraint on their output. All of those indicators tell us that supply and demand imbalances in the labour market haven't yet normalised. We're still seeing that demand is quite a bit stronger than supply, and it seems like it's going to be a slow process of normalisation.
Number 3, ANZ's Chief Economist for Greater China, Raymond Yeung, noticed a significant uptick in tourist numbers from mainland China in Hong Kong over the long Labor Day holiday weekend just gone, suggesting some consumers and travellers there are coming out of their shells.
Even though a lot of people are concerning about, the Hong Kong and tourist industry, because there was an impression that these tourists are not spending money, but it seems to me that they did during the holiday of the past few days, in Hong Kong. And the first quarter GDP of Hong Kong also beat the market expectation with 2.7% year-on-year increase in the first quarter. And now I see that there might also be a chance to beat the market expectation again, and at least the momentum will pick up in the second quarter based on the number of tourists.
Number 4, Indonesia's annual GDP growth ticked up a touch to 5.11% in the year to March, helped by government spending in the lead up to February's general election, as well as private spending. ANZ economist Crystal Tan says this helped offset weaker investment and lower exports.
We think growth momentum will slow going forward as some of these temporary boosts related to the election and also holiday spending fade. But still, domestic demand will continue to be the key growth driver. The outlook for external demand is a little challenging, but there have at least been some signs of stabilization, with prices of some of Indonesia's key commodities showing modest improvement. So overall, we continue to expect full-year growth this year to come in at 5%.
Number 5. Crystal expects Taiwan's annual CPI for April to print around 2.5% today, with monthly inflation to pick up due to higher oil prices. Meanwhile, in the Philippines, ANZ is expecting annual inflation of 4.1% today.
This would mark a third month of acceleration and also a breach of the central bank's 2 to 4% target band for the first time since last November. And it's going to be food and fuel prices that were the key drivers of the inflation pickup.
Crystal Tan there. Now, in part 2 of our bonus deep dive interview on the US-China relationship, if Donald Trump is re-elected, ANZ's Chief Economist for Greater China, Raymond Yeung, looks at how reduced Chinese demand for US Treasuries might affect global interest rates and the US dollar. So if China doesn't need to buy so many US Treasuries, and at the same time, the US government is borrowing a lot more because it's running big fiscal deficits, what might that do to long-term US Treasury yields and therefore long-term global interest rates? Because often US Treasury yields provide the base.
Now, obviously, China is one of the many buyers of the U.S. Treasury. We cannot say that if China stopped buying U.S. Treasury and that would put the U.S. government or the fiscal position into trouble, because we do have other buyers such as the Japanese or even the Fed itself is the biggest buyer of the U.S. Treasury. But now, obviously, the market will react to that. And currently, we know that the U.S. dollar holding of China has amounted to only 775 billion. It's less than 1 trillion. You know, that was the threshold in the past. But we have seen that China's had already started cutting down the US dollar holding in the past few years. But still, the market may react to this type of news negatively, and that would definitely affect the market pricing of US Treasury. So we don't know, in the end, how it ends up, but that will, I think what's certain to me is that will induce some market volatility in the US dollar bonds market.
And just finally, that period from 2000 to 2016 was one where China's manufactured goods were being sold into the market. It was helping to keep inflation low. China's purchases of US Treasuries were helping to keep US interest rates low. If we do see a deglobalization process, obviously not all at once, but a process which seems to have started, what might that do for sort of long-term inflation trends globally? Because on the face of it, it might hold up inflation and interest rates for a bit longer than maybe we might have expected if we were thinking about the pre-COVID trends, the pre-Trump trends.
It seems to me the China deflation story is a mirror of the global inflation story in a decoupling world with the deglobalization. So all start with D, and coincidentally or accidentally, but you see that in an ideal world that with free trade, with very globalized world, and the China production base has been very established, it has been a very good stabilizer to global inflation because of how efficient the China manufacturing sector can contribute to keep price low, globally. So now with this type of uncertainty in terms of the trade outlook between the two countries, this will, plus the fact that, if the US is imposing higher tariff to its own import, that will raise the price, domestically, and that will both yield to the CPI in the US because of this type of policy.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 7th. Catch you tomorrow with all the detail on the RBA's decision today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. please view the podcast disclaimer available via your media player or email.